there is nobody in government who actually understands the relationship between gold and currency.
Yeah,
they
that's a
all
good
think
point.
the dollar is actually money. It's not.
Yeah.
They don't understand this. They have got to relearn economics. They've got to relearn what money is and what credit is.
Right.
Gold is real, legal money without counterparty risk. So, to a lesser extent, is silver. The point being, it is final settled under common law. And this was set up by the Romans way back in 448 BC, would you believe? I mean, it's that old.
Yeah.
So, when it comes to credit is not final settlement.
When the dollar starts melting under runaway inflation, gold isn't just an investment. It's your lifeboat. It's like gold is shouting, print all the paper you want. My value never changes. And investors are hearing the message. In the last 2 weeks, gold has exploded past its April highs after months of quiet consolidation. Think about this for a second. Since Nixon closed the gold window in 1971, the dollar has lost 99% of its buying power. That same 400-ounce gold bar that cost $14,000 back then, today it's worth nearly $1.4 million. Alasdair Macleod, the veteran head of research at Gold Money, says this isn't just inflation. This is the endgame for fiat currency. His warning is blunt. Get out of credit now. Our entire economy runs on credit, and when it breaks, so does everything built on top of it. Gold is the only money left standing with no counterparty risk, and with G7 debt spiraling, time is running out. He's calling for a deep recession that will smash through the so-called ceiling on U.S. Treasury yields. Central banks now own more gold than the U.S. government holds in debt, an astonishing fact. With $37 trillion in obligations, collapsing demand for treasuries, and surging borrowing costs, the dollar is falling faster, and gold demand is on fire. This isn't just another market dip. Macleod compares it to the 1920s credit bubble that led to the Great Depression, except this one is bigger, global, and supercharged by tariffs. The real fix would be a return to the gold standard, but he says that's politically impossible because the people in charge don't even understand the difference between money and credit. So before we dive into Macleod's hard-hitting conversation with Craig Hemke, make sure you subscribe and ring that bell, because what you're about to hear could change the way you protect your savings.
I'm really concentrating on my Substack, and I've got a mission, and that's to educate as many people as possible about what is actually happening. And I think it's so important because we're looking at the destruction of fiat currencies. I mean, the fiat currencies started in 1971. Currencies were already weakening off the dollar, off the gold standard before then. And now 54 years later, it's coming to an end. And that's damned important. It's very important to understand really what that means for individuals and what it means for their, not just their portfolios and all the rest of it, but for their currencies as well. So that's my mission, to try and educate as many people as possible. I mean, the purchasing power of the dollar has is fallen 99%. Those are the numbers you're saying. 99%. Since the dollar went totally fiat. Now, the dollar started declining before then. I mean, bear in mind that until 1934, you had $20.67 to the ounce, and that was from, 1856 or something. And it was, it was de facto, but then it became de jure with the Gold Act in 1900. Basically, when the Fed came along, they screwed everything up. Because under Benjamin Strong, they expanded credit. I mean, Benjamin Strong was a great believer in stimulating the economy with extra credit. And that led to the Roaring Twenties, which led to the collapse between 1929 and 1932, enhanced, I may say, by not President Trump, President Hoover's tariffs at that time, which was the Smoot-Hawley Tariff Act of 1930.
Yep. And
President Trump is doing exactly the same at the top of the debt-cum-credit bubble, which makes 1929 look like a pimple. I mean, this is the big one. It really is. And it'll destroy the currency. I think it's so important. We've got to understand this, and we've got to be prepared for it. The way I've described it to everybody who will listen is get the hell out of credit. Part of the problem is that people don't understand what credit is. I mean, we know when we've borrowed some money, someone's given us credit, but actually everything in the economy exchanges on credit. It doesn't exchange on gold.
Right.
Gold is real legal money without counterparty risk. So, to a lesser extent, is silver. The point being, it is final settlement under common law. And this was set up by the Romans way back in 448 BC, would you believe?
Yeah.
So when it comes to credit, credit is not final settlement. So, okay, you might think you're getting final settlement. You sell a service to someone and they pay you from their bank account. That's not final settlement because you become a creditor of that bank. And then that money you paid into your account and your bank becomes a creditor of you. It's not final settlement. And if you look at the currency itself, that's not final settlement either. Because if you look at the central bank's balance sheet, you've got credit and bank reserves on one side as liabilities of the bank. And guess what? It's got to be backed by assets of the central bank on the other side of the balance sheet. This is not final settlement. Everything is credit. And it's best to understand that. So even if not just currencies, bonds obviously are credit. You own bonds, someone owes you. You're aware that most of this is government. And if government reneges, you've had it, you've lost it. That is the risk you're taking. And what I'm saying is that this is the point where that risk is coming out big time. Just look at what's happening to every G7 government's finances.
Yeah, your bond market,
they
our
are
bond market.
out of control. But I think the one that's going to crack it, Craig, is actually the US dollar, because that is the biggest currency on which all the others base themselves.
Right.
We can see what's happening. I've just described why the dollar's purchasing power, and I always like to put it as purchasing power rather than inflation, because purchasing power actually is the better description. That is going down the Swanee. And when that goes down the Swanee, it takes all the other currencies with it.
Mm-hmm.
And I think, the situation, one of the things that's driving it, which you should be aware, and it's becoming a bit more obvious now, is an economy which is going into recession.
Right.
What that means in terms of relation to the debt is, first of all, more debt has to be raised in order for the government's books to balance. And it also means the ability to cover that debt in terms of revenue, tax revenue, if you like, is lessened. So, if you're sitting there as an investor and you're thinking, should I buy this stuff? This is what you're seeing. The amount being raised soaring out of control and the ability to pay for it diminishing. So what are you going to want? You're going to want a higher bond yield, aren't you? So that 5.1% ceiling, which so far we've seen on the 30-year US Treasury, that'll be broken. And when that gets broken, where does it stop? 10%? Well, there is a solution, but politically, it's not on. The solution basically is to really slash public spending and put the dollar back on a gold standard.
Yeah.
But you've got problems there. I mean, the idea that you can get on a gold standard. First of all, nobody believes that they've actually got the gold. They would have to prove that, and governments are not in the business of telling the truth in these matters. So they've got to And furthermore, Craig, there is nobody in government who actually understands the relationship between gold and currency.
Yeah,
they all think the dollar is actually money. It's not. Yeah. They don't understand this. They have got to relearn economics. They've got to relearn what money is and what credit is. So you've got all these PhDs sitting in the Fed and presumably also in the US Treasury. They've got to go on a re-education course. How long is it going to take them to understand that?
Macleod makes it clear the Fed can't fix this crisis because it isn't just an economic problem, it's a systemic one. He warns that history is full of examples where monetary breakdowns lead to political disasters, even war. Germany in the 1920s is the classic case, and Macleod argues that America is now walking down the same road. Soaring bond yields, a weakening dollar, and foreign investors dumping treasuries. According to him, the deadly combination of reckless spending and rising tariffs could push the dollar into full-blown collapse by 2026. And once hyperinflation starts, no politician, no central banker, no president can stop it. Right now, the U.S. isn't technically in stagflation, but we're getting dangerously close. After Donald Trump's new tariffs were announced in the spring, official numbers initially showed that the economy was holding up. Job growth looked steady, and inflation even fell to 2.3%, the lowest level since 2021. The Trump administration has urged Americans to be patient with the impact of tariffs, even claiming that government data has been skewed against the president. And with that backdrop, Macleod turns back to the heart of the interview. warning that the next chapter could be far more chaotic than most investors are prepared for.
I mean, the fact of the matter is that the Fed has got no control over the situation, and it can't have control over the situation because the situation is politically driven. And until you persuade an electorate, to give up all their welfare this and welfare that, and, all the pressure groups to, that, look, you're out of here, forget it. We're actually going to deal with this one seriously. Until that happens, no. I mean, there is absolutely no solution, Craig. And, I've always said it's crisis first, solution second. I mean, once you have the crisis, then you can start talking about a solution. But is that really going to work? Well, I'd like to think so. But the fact of the matter is that when you get those extreme economic and monetary conditions, like, the credit collapsing in terms of its value, all bets are off. I mean, this is what they found in Germany, because what happened in 1920 to 23 led to Hitler, led to the Second World War. Now, so far, we've had the post-COVID thing, which led to inflation, da-di-da-di-da. And now, guess what? Perhaps the long bond yield has not really declined. It's still held between 4.5% and 5%, and looks, if it goes through 5%, then we will be bricking it. It really will be very serious. But meanwhile, of course, the S&P went up from something like 4,200 in 1922 to where we are now, which is 6,500. This actually looks very, very much like that period in Germany between 1920 and 1921. So what follows? Well,
right. That's the bad news.
This is where we are. So how is it going to happen? That's the question. Well, I can see a number of things. We just had Stephen Mirren appointed to the FOMC. No, he's not quite there, but it's just a question of signing on the dotted line. He will be in the FOMC. He was the Mar-a-Lago guy who wants the dollar down and reckons that he can get everybody to agree to it. Well, good luck to that. They are going to destroy the dollar.
Yeah.
The foreigners so far and large institutions, for some reason, are asleep at the wheel. They don't understand what's happening. There is a deliberate policy to drive the dollar lower. And if you look at the chart of the trade weighted, it is awful. It's about to fall from where it is, which is about 197.5, down to 90, and I doubt it'll stop there. So what's this mean? This means that the purchasing power of the dollar is declining. Mm-hmm. Now, on top of that, what do the foreigners do? Well, I mean, everybody, including the large institutions, stand back and they don't buy Treasury bonds. I mean, certainly with anything mature, in terms of length of maturity, they're not going to touch it. The only thing that will sell is near cash, which is actually what T-bills are. It's almost like cash, printing cash. So that's what's going to happen. Now, you will get a rising level of bond yields just at the moment when the Fed is trying to reduce interest rates. Well, that's going to do. They're going to have to reverse that. Or the dollar tanks. And if the dollar tanks, what does that do to its purchasing power? It begins to collapse. And then, on top of that, we've got tariffs. Now, I know everybody's running around saying, well, tariffs haven't had any effect. But it does take time for this to work through. And I reckon in 2026, you're going to see a combination of a collapsing dollar, higher tariffs, pushing up prices, if you like. And, I mean, that's so much like Germany between 1922 and 1923. So the next question is, I mean, we all reckoned that the Germans were muppets and stupid and all the rest of it at that time. But actually, if you read the history, you see, well, it was politics. It was politics. And also, there were elements of industry which were quite happy to see a lower mark because it lowered their manufacturing costs. You had the inflation king, Hugo Stinnes. You had, and this is a familiar name even today, Fritz Thyssen, steel magnate, etc. I mean, it was wonderful for them. They were making huge money because their costs were based in Reichsmarks, and they were selling it into global markets and getting gold-backed dollars for it. I mean, it was brilliant. But once the collapse really starts, it just gets a momentum of its own. And I cannot see any politician in America or anywhere else in the world with the authority to deal with this situation. This is a frightening situation. And the moment this bubble pops, and it is a bubble, Craig, the moment this bubble pops, we will be going into that phase, which they had in Germany between 1922 and 1923. And for those who don't know, or don't have a sense of inflation history on this one, before the war, 1914, when the Reichsmark was on a gold standard, the gold mark, in other words, was worth 23 US cents. At the death in November 1923, there were over 4 trillion marks to the dollar. That was the scale.
Today, CPI is still running around 3.2%, yet the Fed is already talking about cutting rates, proof that this economy is addicted to cheap money and endless stimulus. And that's the problem. The only path forward seems to be more debt, more spending, and more currency debasement. Alasdair Macleod's warning is crystal clear. The destruction of fiat currencies isn't coming someday. It's already underway. That's why physical gold and silver aren't just investments. They're protection. Central banks already own about 1/6 of all the gold ever mined, and they're still buying. So here's the big question for you. Do you believe the dollar is entering its final chapter? Will investors wake up to gold's role as real money before it's too late? Or will they only act after the system breaks? Drop your answers in the comments. We want to hear what you think. And if this video gave you a new perspective, hit like, subscribe, and turn on notifications so you don't miss the next update. The storm is building. Make sure you're ready.